Hey, Steve Saretsky here. Welcome back to the show. Quite a bit to touch on this week. I wanted to put a video together to sort of frame up what I think is happening in the Canadian housing market and some potential sort of scenarios and outcomes. Because coming into this year, right, there was this, the housing market was pretty slow, but they started to sort of build. There was a narrative that started to build and a sentiment that, hey, you know what, we're going to get some rate cuts in 2024. The markets were pricing and expecting 100 basis points of rate cuts from the Bank of Canada. I think 6 from the Fed, from the U.S. Federal Reserve coming into this year. And so the sentiment started to shift, was saying, okay, well, if that's the case, if I'm reading in the Globe and Mail that the Bank of Canada is going to start cutting rates, we're starting to see mortgage rates drop, I should get in the market now before I have to start competing in bidding wars again. And again, that's just the general sentiment and narrative in Canadian housing. Whether you agree with it, disagree with it, think it's kind of ridiculous, all I can tell you is, like, anecdotally, the conversations that I have, the people I talk to, the overall sentiment in the industry, that's the sentiment and that's the narrative that's getting passed around. And you're seeing this happening now. You're seeing the stories and you're hearing about it is, hey, all of a sudden, like, a lot of the older listings are suddenly under contract. Some of these houses are now going back into multiple offers. And so they're starting to get a little bit of panic, similar to how we did last spring, right? Rates came down and open houses got busy again. And so there's this narrative out there that people are trying to front run the Bank of Canada. And I definitely believe that it is in fact happening. And we can see this. You look at, we just had the latest January data for Greater Vancouver. Home sales have spiked up from, January of last year, coming off, though, a really low week base. So overall, if you kind of zoom out, sales were still below the long-term 20-year average for the month of January. But when you overlay that, we're still running into an inventory problem. There's just not a lot of supply on the market for sale. And if you can, particularly for single-family homes, I've talked about this before, but if you look at the number of new listings for single-family detached houses in Greater Vancouver, is the second lowest count of any January dating back the last 20 years. So outside of last year. So the overall level of inventory still remains really low. And that's why you're starting to see, again, some of these houses going back into multiple offers. And so the long story short is I've cautioned people about, okay, well, if everybody, let's say, hypothetically starts front running the Bank of Canada, does the Bank of Canada then turn around and say, well, hold on a minute, things are going all right. Housing is starting to reaccelerate. If we're worried about inflation sort of coming back, what's the reason? Why are we cutting rates? So it's, again, kind of like a repeat of the spring of 2023 where housing accelerated and the Bank of Canada had to come back in later in the year to raise rates once again. And this is what we've been talking about in the Loonie Hour coming into this year, was basically the thesis that was kind of widely circulated by a guy named Jim Bianco. So Jim Bianco covers basically the U.S. markets. And his thesis was kind of contrarian to most of the general mainstream, which was that he felt the U.S. was actually going to go through like a mini boom. That the economic data, wasn't going to be that bad. That not only were you not going to have like a soft landing, like you were going to get like a no landing. And again, some people think that's totally nuts, but so far, Jim Bianco has been right. If we got out just last week, you had U.S. GDP numbers came in higher than expected. Just this week, we had U.S. non-farm payrolls, right? The big labor market number that everybody's watching and paying attention to, again, beat expectations. Like none of the underlying economic and labor market data in the U.S., the world's most important economy, which influences the BOC here in Canada, that data is just not deteriorating to the point that everybody expected it to. And so now what's happening is interest rate markets, futures markets, the bond market is suddenly having to sort of reprice themselves and reposition. They're starting to remove and price out these rate cuts. Bond yields are starting to push back up once again. So just on the announcement today on the U.S. non-farm payroll, for example, bond yields surged, and the ramifications here in Canada was the Canada 5-year bond moved like 16 basis points in a single day. That's like a massive, massive move. And so, again, as I would kind of caution people coming into this year, it's almost like we have to be careful what you wish for. It's like you kind of need the housing market to kind of, if it gets too hot, you have to think that there's a very strong likelihood that bond yields push back up once again, that the Bank of Canada pushes rate cuts further out once again. And so I think, while again the narrative in the industry is that this is going to be a rip-roaring spring market, great, maybe it is, maybe it isn't. But I think what puts a hard brake on the spring market is yields pushing back up to the point where you get mortgage rates moving once again into the sixes. And so I would just caution everybody that remains a very realistic scenario. I did several speeches recently for, people in the industry, real estate development conferences, things of that nature. And I've kind of said, this is going to be the year of volatility. Similar to the year last year, we're just in this sort of new framework where things are incredibly difficult to predict, right? We've heard so many people over the last 2 years, right, that like you're going to get this economic hard landing, hard recession, housing is going to sell off, it's going to be disaster. And like we really haven't seen any of that. Like housing kind of sold off and picked back up. The stock market's like it's ripping, it's still going. The U.S. economic data still looks good. The labor market still looks pretty good. So these are difficult, and I can tell you, like central banks are having the same difficulties narrating. So this long story short is the economy is still kind of strong, at least in the U.S. And so you're still. It makes it hard that, how confident are we that inflation is really going to roll over or at least not come back? And so, I would argue that inflation still kind of sticky in Canada too. We had some comments this week, in fact, from Bank of Canada's Tiff Macklem in Parliament this week. Let's clip to those comments right here.
I would emphasize a couple of things. First of all, Canadians are paying shelter costs. They're a real cost. I don't need to tell you, you're even more aware than I am. It's really having an effect on Canadians. So we can't just ignore them. This is really, affecting Canadians. The second thing is, even if you strip out shelter costs and you look at the rest of inflation, they're still, shelter is not the only source of underlying inflationary pressures. One way to look at that is, the number I gave you is, shelter is the biggest thing that's contributing on the upside, but there are also some things that are unusually weak on the downside. And so if you use a more systematic approach to strip out the ups and the unusual ups and the unusual downs, inflation looks to be about 3.5%. If you look at our core measures, trim CPI, CPI median 3.6, 3.7, CPI ex food and energy, a very simple way to strip out some of the big movers, 3.4. So what that's telling you is, the sort of center of the distribution is still above 3. Another way to look at that is if you look at the number of components of the CPI that are rising faster than 3%, that's still over 50%. So more than 50% of the basket is still rising higher than 50%. Normally, that number's quite a bit lower. So shelter costs are an important factor, but they're not the only factor.
So again, Tiff is referencing, shelter inflation that is still keeping inflation relatively elevated, adding a full percentage point. But even when you strip that out, core inflation is still running at 3.5%. If we look again at, the shelter components, there's not a whole lot of bright light at the end of the tunnel. If we look at Canada's overall vacancy rate, other than 2001, we're at the lowest in 31 years here in Canada. Average rent inflation is running at 8% across the country. Turnover rents, which is basically what happens, is like when a tenant lives in your rental apartment and they live there for 2, 3, 4 years and then they leave, what is that rent turning over for? And so right now, the average turnover increase is 24%. So we do have this supply-demand imbalance in this country's, rental market. And again, I've kind of explained this before, where it's like I agree that you can get bubbles, right? You can get bubbles in the resale market. Excess credit, cheap credit, people speculating, pushing prices up. But in the rental market, right? The rental market is a function of supply and demand. How many people are looking for rentals and what is the available supply? And if you have a mismatch, you can obviously push the rental prices up. You can't go to the bank and borrow money again for rental prices. It's just simply a factor of supply, demand, people's wages going into the rental market. And so to see this country's vacancy rate running at 1.5%, again, the second lowest in 38 years, suggests to me that the shelter component of inflation, it could stick around for longer than a lot of people will want to believe, including the Bank of Canada. So, the long story short is I think as the data comes in, as the data changes, I think one has to change their mind, right? I mean, it would be crazy not to get new data points and not at least second guess your opinion on markets. And so that's why I'm always trying to look at it. People are like, oh, this guy, he's flip-flopping. No, I'm just looking at the data and saying, okay, this is interesting as the economy broadly evolves, right? I mean, I think, again, looking at the U.S. economic data that's come in, over the last couple months, you go, it's just not deteriorating. There's lots of jokes about these soft landings. But today, I don't even know if we've had a landing. And to go again, maybe this continues on for another 6, 12, 18 months, and maybe you do eventually get that hard landing. But as it stands right now, the data is still coming in hotter than otherwise expected, and that is going to push, in my opinion, it's going to push these rate cuts further out than I think markets are expecting. And for Canadian homeowners, right? I mean, we've talked about this before, but over 50% of the float, over 50% of Canadian homeowners have not yet been hit with a mortgage payment increase, right? There's a lot of mortgages that are still under old rates that will be coming up for renewal. And the longer that the economic data comes in relatively strong, the longer that you're probably going to be dealing with these higher rates, and you're going to eventually succumb to a higher mortgage payment renewal. So those are kind of the risks in the housing market. We'll continue to monitor this. The reality is I don't think most people watch this channel. Most people are just sort of watching, reading media headlines. And so the housing market, I think, doesn't react as quickly. I think, again, the general sentiment today is this is going to be a good year for housing. The last year and a half have not been good at all. There's this pent-up demand. And so we're going to wait and see how this all shapes up in the months ahead. But I would just brace everybody for a year of volatility and a year of bond yields, again, moving 15 plus basis points in a day is going to be incredibly important for people that are in the market to actively hold mortgage rate holds. Mortgage rate holds are going to be the name of the game once again in 2024. So as always, hope that helped. Pay attention to the data out there. Stay nimble, and we'll see you next week.